The Trump administration is negotiating to acquire a 10% stake in Intel by converting federal grants into stock, as confirmed by U.S. Commerce Secretary Howard Lutnick. This strategic investment follows SoftBank Group's recent $2 billion acquisition of a 2% stake in Intel at $23 per share, which led to a nearly 7% increase in Intel's stock price. The administration's move marks a significant shift from its previous stance, which included attempts to remove Intel's CEO, Lip-Bu Tan, and highlights a broader strategy to strengthen domestic semiconductor production amid ongoing trade tensions with China. This potential government stake is structured as non-voting shares to avoid influencing company management, reflecting a cautious approach while supporting Intel's recovery efforts. The investment aims to revitalize Intel, which has been struggling to compete with rivals like NVIDIA and AMD, and aligns with the administration's goal to enhance U.S. leadership in semiconductor manufacturing, a sector critical for national security and technological advancement. This initiative echoes past government interventions, such as the 2008 bailout of General Motors, and underscores the administration's commitment to securing the nation's technological and economic interests. In other business news, Home Depot reported a rise in sales for its fiscal second quarter, with revenue reaching $45.28 billion, slightly below Wall Street expectations. Despite broader economic concerns, U.S. comparable store sales increased by 1.4%. However, Home Depot warned of potential price increases due to rising tariff costs, reflecting ongoing trade tensions. Meanwhile, the S&P 500 experienced a 0.6% decline driven by losses in major AI-focused companies, while the Dow Jones saw a marginal increase supported by Home Depot's stable forecast. Treasury yields fell as investors anticipate potential interest rate cuts, indicating a cautious economic outlook.
Amer Sports Inc. has raised its annual outlook following a robust second quarter performance, with adjusted earnings per share reported at 6 cents, surpassing the analyst consensus of 3 cents. The company also reported quarterly sales of $1.24 billion, a 23% increase year-over-year, exceeding the expected $1.18 billion. This strong performance is attributed to the Salomon brand's impressive growth, which saw omni-channel sales rise by 28% and operating profit increase by 35% year-over-year. Despite facing challenges such as tariffs, the company demonstrated resilience with significant margin expansion of over 700 basis points. Goldman Sachs analyst Brooke Roach reiterated a buy rating for Amer Sports, setting a price target of $45, highlighting the company's robust results amid high investor expectations. Key highlights include Greater China's momentum and direct-to-consumer (DTC) strength, with management's third-quarter revenue guidance indicating sustained growth. However, Roach cautioned about potential risks such as slower-than-expected growth in Greater China, potential weakening of brand momentum if innovation stalls, and structural concerns due to the company's Cayman Islands incorporation. Despite these risks, Amer Sports shares were trading lower by 6.28% to $35.15, reflecting market reactions to the company's strategic direction and external factors.
The primary financial event highlighted in the news summary is the lawsuit filed by Minnesota against TikTok. Minnesota Attorney General Keith Ellison has accused TikTok of utilizing addictive algorithms that negatively impact the mental health of young users, violating state laws against deceptive trade practices and consumer fraud. This lawsuit is part of a broader trend, as approximately 24 states have initiated similar legal actions against the social media platform. TikTok, however, disputes these claims, asserting that it has implemented safety measures to protect its users. The outcome of this lawsuit could have significant implications for TikTok's operations in the U.S. and may influence regulatory approaches to social media companies nationwide. In another notable development, the U.S. government is reportedly seeking a 10% stake in Intel, following a $2 billion investment by SoftBank Group. This potential acquisition represents a strategic shift by the Trump administration to strengthen ties with major semiconductor manufacturers amid global supply chain challenges. Such a move could bolster U.S. technological leadership and competitiveness in the semiconductor industry, which is crucial for various sectors, including automotive and consumer electronics. The negotiations underscore the growing importance of securing domestic semiconductor production capabilities in light of geopolitical tensions and supply chain vulnerabilities. Additionally, the Supreme Court has allowed Mississippi to enforce a law requiring age verification on social media platforms like Facebook and X, formerly known as Twitter. This decision reflects increasing regulatory scrutiny over children's use of social media and highlights the ongoing legal battles surrounding privacy rights and free expression in the digital age. The outcome of these cases could set precedents for how states regulate online platforms and protect users, particularly minors, from potential harms associated with social media usage.
U.S. Treasury Secretary Scott Bessent announced plans to begin interviewing candidates for the Federal Reserve Chair position shortly after Labor Day, indicating a proactive approach by the Trump administration to secure leadership aligned with its monetary policy goals. The list of 11 candidates includes notable figures such as Fed Governors Michelle Bowman and Christopher Waller, White House economist Kevin Hassett, and former Fed officials like Kevin Warsh and Larry Lindsey. This early initiation of the selection process, despite current Fed Chair Jerome Powell's term not expiring until May 2026, underscores President Trump's urgency in advocating for interest rate cuts to stimulate the housing market. The administration's push for monetary easing comes as the U.S. grapples with a sluggish housing sector, which Bessent suggests could benefit from rate reductions to spur home building and curb future inflation. The Fed's forthcoming monetary policy meeting in September is anticipated to result in a rate cut, the first since December 2024, amid rising producer prices attributed to increased portfolio fees from stock market gains. This strategic move aims to bolster economic growth and manage inflation expectations, reflecting the administration's broader economic priorities.
CI Banco has filed a civil lawsuit against the U.S. Department of the Treasury and its Financial Crimes Enforcement Network, FinCEN, in response to sanctions that block its access to the U.S. financial system. The sanctions imposed on June 25, 2025, accuse CI Banco of facilitating money laundering activities linked to opioid trafficking. CI Banco argues that these sanctions were levied without notice or the opportunity for defense based on unspecified allegations. The bank contends that this action threatens its survival, endangering $40 billion in managed funds and potentially leading to the loss of over 3,000 jobs. The lawsuit seeks to overturn the sanctions and demands compensation for damages already incurred. The repercussions of the sanctions have been significant. Visa has severed ties with CI Banco, leading to the deactivation of approximately 290,000 debit and prepaid cards, affecting customers both in Mexico and abroad. Furthermore, U.S. financial institutions have frozen Cibanco's accounts holding over $38 million. The bank warns that the Treasury's decision could disrupt the fiduciary management of pension and investment funds, impacting numerous U.S. investors and potentially causing substantial financial losses. Amidst this turmoil, Grupo Financiero Multiva has announced its intention to acquire Cibanco's fiduciary business, a move aimed at stabilizing the sector and ensuring continuity for the trusts involved. However, this transaction awaits regulatory approval and has yet to be reflected in financial system indicators.
Ford Motor Company is adapting its electric vehicle (EV) strategy by leveraging its new battery production capabilities to generate additional revenue streams. The company's joint venture with SK On, Blue Oval SK, has commenced battery production at its Glendale, Kentucky plant, initially to power the F-150 Lightning electric pickup. However, Ford plans to sell excess batteries to other potential clients, including energy storage companies and rival EV manufacturers. This move comes as Ford faces a 10% decline in EV sales in the first 7 months of 2025 compared to the previous year, and anticipates increased market competition following the expiration of a $7,500 tax credit in September. In response to these challenges, Ford is also revising its broader EV strategy. The company is scaling back operations at its Kentucky facility, reducing workforce numbers, and pausing production at a second plant in the state. Despite these cutbacks, Ford remains committed to its long-term EV goals, planning to launch a more affordable line of electric vehicles based on its new Ford EV Universal platform. The first model, a midsize electric pickup priced around $30,000, is expected to begin deliveries in 2027. This shift to more cost-effective lithium iron phosphate batteries, produced in Michigan with technology licensed from China's CATL, is part of Ford's effort to achieve profitability in its EV segment, which reported a $5.1 billion loss last year.
Billionaire investor Howard Marks, chairman of Oaktree Capital, has raised concerns about current market valuations, suggesting they have moved from elevated to worrisome. In his recent memo, The Calculus of Value, Marks emphasizes the importance of fundamentals, such as earnings potential and management quality, in determining a company's true value. He warns that markets can remain irrational longer than investors can remain solvent, highlighting the gap between weaker earnings power and higher valuations. Marks points to indicators such as the S&P 500's forward P/E ratio of 23, the Buffett indicator reaching an all-time high, and Barclays' equity euphoria indicator doubling its normal level as signs of a potential bubble. The concentration of market gains in a few tech giants, Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla, further underscores the market's narrow breadth. These Magnificent Seven account for a significant portion of the S&P 500's returns, while the remaining stocks carry higher than average P/E ratios. Marks advises caution, recommending a shift towards defensive positions as the market enters what he terms InvestCon 5, a stage where reducing aggressive bets is prudent. Despite the current market euphoria, Marks believes that respecting fundamental value will ultimately prove advantageous when market sentiment shifts.
Home Depot, a major home improvement retailer, is contemplating price increases on select products as a result of the Trump administration's tariffs, which have raised the costs of importing goods. According to CFO Richard McPhail, these potential price adjustments will be limited to certain categories. Despite reporting a revenue increase from $43.18 billion to $45.28 billion in the second quarter of 2025, Home Depot's financial performance did not meet Wall Street expectations, primarily due to consumer caution amidst economic uncertainty. Nonetheless, the company's stock rose over 4% in early trading, indicating investor optimism. The broader economic environment is characterized by rising inflationary pressures, highlighted by a 0.9% increase in the Producer Price Index in July, the largest monthly jump in over 3 years. This has resulted in a 3.3% year-over-year increase in wholesale prices. While U.S. importers have so far absorbed some of the tariff-related costs, there is a growing risk that these costs will be passed on to consumers. This sentiment is echoed by industry experts and other companies, such as Arizona Beverage Company, which is also considering raising prices for the first time in decades due to similar tariff pressures. These developments underscore the inflationary challenges currently faced by both businesses and consumers.
Rocket Companies has seen a shift in analyst sentiment over the past quarter, with 9 financial analysts offering a range of perspectives from bullish to bearish. The average 12-month price target for Rocket Companies has increased by 21.41% to $16.22, up from a previous target of $13.36. Analysts have set a high estimate of $25 and a low estimate of $14, indicating varied expectations about the company's future performance. This change in sentiment reflects a growing confidence among analysts, although the company's financial metrics reveal certain challenges. Despite achieving a revenue growth rate of 3.18% as of June 30, 2025, Rocket Companies faces difficulties in profitability and asset utilization. The company's net margin stands at -0.14%, and its return on equity, ROE, and return on assets, ROA, are -0.04% and -0.01%, respectively, all below industry averages. These figures suggest challenges in cost control and efficient use of capital and assets. However, the company's market capitalization is above the industry average, indicating strong market confidence. Additionally, Rocket Companies maintains a conservative debt approach with a debt-to-equity ratio of 1.33, below industry norms. As Rocket Companies continues to navigate these financial challenges, investors should consider both the positive revenue trends and the underlying profitability issues when evaluating the company's market potential.
African startups have achieved a significant milestone in 2025, raising $2 billion in venture funding despite a slow August. This marks a notable increase from 2024, when the total funding reached $2.2 billion for the entire year. The funding landscape in 2025 has been characterized by a substantial shift towards debt financing, with 89% of July's $550 million funding coming as debt, raising the year's total debt financing rate to 45%, compared to 28.5% in June. This trend could indicate a changing risk appetite among investors or a strategic pivot by startups seeking more flexible financing options. Key players in this funding surge include Egypt and Kenya, which have dominated the investment scene, while Nigeria, traditionally a strong performer, has experienced a funding drought. This shift may be attributed to Nigeria's reliance on equity funding, which has seen a decline as debt financing becomes more prevalent. The preference for debt over equity could have longer-term implications for the growth and development of early-stage startups, particularly in Nigeria, as they may face challenges in securing the necessary capital to scale. The overall increase in funding highlights a robust investor interest in African startups, setting the stage for potentially record-breaking investments by the end of the year.